Investors Chronicle.
Welcome to the Companies and Markets Show. It's Thursday, the 23rd of March as we record. With me today are Alex Newman. Welcome, Alex.
Hi, Dan.
Julian Hofmann.
Hello, Dan.
And Mark Robinson. Hi, Mark.
Hi, Dan.
Coming up, we are taking a closer look at the latest developments in the banking sector after another week of fairly hectic activity, and of course, the emergency takeover of Credit Suisse. And it is also the end of the tax year in a couple of weeks, so this week's magazine is a bumper edition, our annual ISA special. To mark the occasion, we are speaking to FT consumer editor and former IC stalwart Claer Barrett. We will be discussing her book, What They Don't Teach You About Money, a conversation that's full of interesting points. I can say that because we pre-recorded it. And it is of interest even if you consider yourself well-versed on the subject of money, as many of our listeners hopefully will. So that's coming up. Before all that, though, we are starting with rats and insects, specifically Rentokil, which reported full-year results last week that were very well received. Mark, you covered the figures for us. It's fair to say that the blockbuster Terminix acquisition has got off to a decent start, it seems.
Yes, definitely. Management highlighted the positive effect it's had on margins, albeit it's only been integrated within the company or within the group for a few months now. In fact, it was just one of a number of acquisitions through the year, over 50, I believe, which is not unusual for Rentokil. But this acquisition was described by management as a landmark deal, and if early indications are to believe, then that's more than warranted. I got one of the points I think that you made prior to coming on air here is that how can we gauge it at this stage, and it does come down to management's early comments as well, and they alluded to the benefits that it's had on profitability, which would be something really, because if you look back beyond 2022, when they had so many acquisitions, Rentokil's gross margin was averaging something in the region of 23%. It drops down to about 12-13% at the operating level. So the implication is that Terminix was going to have to be a pretty profitable business in order to match those levels. I guess the other interesting point about it as well is that it always relates to the debt pile itself. And while it only represents 79% of shareholder funds, I was looking at the quick ratio for Rentokil as well, and that provides some consternation. But it is a cash business. The cash flows are fairly predictable as well, because a lot of them are predicated on long-term contracts, and many of those contracts as well are flexible in terms of price pass-through. So I think we will obviously have to wait to the interim results to see what impression that it has on the bottom line. But I think the early indications are pretty positive. I mean, it's placed Rentokil in a fantastic position within the world's largest pest control market in the US as well. It's got the same defensive qualities as Rentokil. So I mean, if all the synergies are correct that they're pointing to, then it really will be a very significant deal for the company.
Yeah, just to put a bit of colour on the deal, it was late 2021. I think the deal was agreed. 5.4 billion, pretty significant even by the standards of an acquisitive company. As the name suggests, Terminix is focused on termites, which, while not such a big deal over here, are a big issue in the US because of the prevalence of timber frame housing, which we discussed on a recent podcast in a separate issue. Rentokil, I suppose, when people hear the name, you think of residential pest control, but historically, I think about 80% of their business in pest control has been commercial. Terminix is a bit different. It is a little more focused on the residential side of things, so it does sort of balance that out a little bit more. As you say, Mark, this company, this business is what seems like a classic defensive play. The pest problems don't rise and fall in line with economic cycles. So, the organic growth, which Rentokil reported last week, even aside from the Terminix deal, is in theory still going to be coming through whatever the state of the economy.
Well, exactly that, isn't it? It's if you've got a rat in your house or you're infested with termites, it doesn't fall under the heading of discretionary expenditure, does it? So, and plus, as you mentioned there as well, the high proportion, as far as Rentokil goes, of sort of commercial contract work augurs well for the future as well. I did note that within the results there was a marked fall away in the in volumes for disinfectants that Rentokil produce. That was to be expected of it. It's one of those post-COVID impacts as well, and that's we've seen that across the board in other companies such as Procter and Gamble as well. Um, that was only a relatively minor effect. Other than that, volumes are pretty steady, really. Um, on a rating thing, it's a fairly high forward rating of 26 times, but we've um, we maintain that it's basically a long term buy and forget option for your portfolio. It's a type of company that like a value investor, like a Warren Buffett, would automatically gravitate towards. So we think, even though it is that rating is a little bit on the high side, given the successful integration of Terminix, we think, um, I think it's trading around about the 540 mark at the moment. That's a decent entry point.
Alex, you wanted to talk about Rentokil because, as it happens, it has risen to the top of a screen you've been looking at recently, a stock screen on a few metrics.
Yeah, I mean, it's kind of a stock screen I'm trying to develop, which I mean, I provisionally called it the strong and stable screen, but I suppose for those who don't like political jinxes, we might have to rebrand it. But the idea is to kind of take an agnostic view of valuation and earnings growth, and basically look at stocks whose share price over the last year has been pretty stable as a sort of proxy for being able to handle what is, a really tricky background, a backdrop for business, and I suppose investors' appraisal of future cash flows, etc. And so there's also a liquidity test in there, but I mean, for a company like Rentokil, it's not really an issue because it's a big FTSE 100 name. And in addition to those two tests, the screen also looks for how close the stock is to its 52-week high, and for stocks with good sort of top quartile momentum. And if you put all these qualities together, you basically have a group of sort of very high quality stocks and other names in there like Smiths, Bunzl, Relics, and the LSE. And I think these are companies where okay, they're looking pricey, but sentiment is good, and the stock has been able to hold on to its price gains by virtue of some combination of earnings momentum or investor faith. I mean, until I looked into the Terminix deal and the recent results, I didn't realise actually how successful a year Rentokil has really had, while everyone else has seemed to be having a pretty tough time. But I mean, this the screen, it's kind of looking for a proxy of companies which might survive. If there's a continuation of the environment we've seen over the last year, and yeah, I mean, for the reasons we've talked about, I mean, it doesn't get more defensive than the job of a ratter, really.
Yeah, I think that's a fair point. On the Terminix deal, there maybe are a couple of technicalities to flag just in terms of how that's accounted for. One issue, as far as I understand it, with Terminix is as with, I think, Rentokil in general, but with termites, you do get a warranty when your home or your property is protected against these mites, and that does open up the potential of legal action in future. I think it's a very small proportion of customers. I think Rentokil is actually capping the liabilities there, but the way it accounts for those claims is changing slightly. It says in the presentation, simply because under US accounting rules, litigation claims were expensed through the P&L. Under IFRS, the future liability has been modelled and been put on the balance sheet, so that is going to reduce cash conversion a little bit, and is something to watch for, but I don't think it's necessarily going to be a damaging factor for the business as a whole. The other thing, maybe just to conclude on this section, Terminix is a big US business. Rentokil does have big ambitions there. Management was quite unequivocal, actually, when asked on the analyst call about listings, which again is a subject we've discussed in recent weeks. When it was asked about the prospect of a US listing, it said, we're not looking at this at all. Not even additional listing. They're very happy to be a British company, which is refreshing on one level to hear. And some analysts actually have pointed out an interesting point. Rentokil does still have ambitions in Asia and Asia Pacific. It does have interest there already. That the UK, purely from a temporal perspective, is quite a good place to be if you're a global business, meaning you can manage the company in Asia and in the US, all from a time zone in the middle.
Crawley, the centre of the world.
Exactly.
The headquarters.
So perhaps that will be the saving grace of the UK market, the fact we're Greenwich Mean Time and all that. We'll move on to our second segment, though. We are talking again about banks. Things have quietened down a little bit as we record, but since we last recorded, there has, of course, been the emergency rescue of Credit Suisse by UBS. There's been a lot of outcry over a particular aspect of that rescue, which we'll come to in a moment, in terms of the wiping out of the AT1 bonds that Credit Suisse had issued. There are also still lingering concerns in the US, of course. First Republic Bank is the latest to be facing quite a lot of pressure, certainly stock market, share price-wise, despite an actual infusion of deposits from Wall Street last week. So let's start with Credit Suisse, Julian. A storied bank, albeit, as we said last week, one that has had scandal after scandal in recent years, and that perhaps ultimately prompted its downfall, given it was still very shaky at a time of mass uncertainty, really.
Well, yes, you can pick your nickname, either Debit Swiss or Credit Suicide, whichever one is most appropriate. So, I mean, the difference between now and last week, as you mentioned, is that the Swiss regulators have basically decided to upend the relationship of bondholders and equity holders in the company by effectively wiping out the junior bondholders in preference to giving the equity holders at least a stake in UBS, which stepped in to take over the shell of the company. This has caused a lot of commentary. It's fair to say we're already seeing that bond prices for banks have risen quite sharply in response to that. So essentially, debt holders are demanding more payment for risk now that it seems that their traditional rights over the ownership of the company have been upended. We do have to emphasize that these bonds were kind of high risk anyway, so holding them came with a certain number of caveats, but they were sort of sold on the basis that the bondholders would have some kind of claim on the underlying asset, and that now has disappeared. So it's a very bold action, you could say, by the Swiss, or brave or courageous, whatever civil service term is most appropriate in that sense. But it does have a ripple effect. I think that's the thing about this particular crisis that is its most salient feature, that having solved one problem, you seem to create another one in a slightly different way further down the line for other institutions. But having said that, Credit Suisse itself was a fairly unique case, I think it's fair to say, in European banking, in that it shared quite a lot of the features of SVB in America, in that its deposit base was very concentrated. It had single, very high net worth individuals who deposited their money there, and it's exactly that kind of group that will just take money out and move it somewhere else at a moment's notice. So in some ways they had this strange kind of similarity, but I think it's fair to say that we won't have heard the last of that issue throughout the rest of the sector, but we'll just have to see how it pans out.
Yeah, on the CoCos, I mean, we wrote a little bit about them this week. The contingent convertibles, as they're known, the bonds that were wiped out. I mean, this has happened a couple of times before. legal action has happened as well a couple of times before, which perhaps emphasizes the contingency of the contingent convertibles. Banco Popular, Yes Bank in India. In both cases, there were aggrieved bondholders very upset at being wiped out. There's been a lot of discussion this week about, the bond prospectus, whether the legality was, there to begin with, whether it was a function of the laws that were actually changed on the weekend as part of the rescue deal by UBS. A lot of it seems to stem from whether or not this was a viability event. If it was, then that does allow for a write-down. The question, I suppose, Alex, maybe I'll come to you on this, a difficult question, albeit I have an opinion that I'm going to throw in at the end, is whether this might, permanently increase the cost of capital for banks, make fundraising more difficult in future. AT1s, contingent convertibles, were designed as an additional method of raising capital alongside common equity tier 1. If bondholders are now going to demand higher rates, might make it more difficult to issue these bonds in future.
Yes, well, big question, as you said. I think you pointed out this morning when we were sort of talking about this in the news meeting that the price of AT1s in more liquid markets seems to have rebounded a little bit this week since they fell off a cliff on Monday. There's a lot of people very, very fearful suddenly about this already high risky asset class, which Julian alluded to, being a lot riskier than they thought it was. I mean, the other thing that I thought was very interesting on Monday is that we had quite quickly a message rushed out by the ECB following the sort of weekend Swiss drama, which essentially implied that this wouldn't happen in the same way in the event of a eurozone bank collapse. But I mean, the rules are different already. But it does go to show the problem about solutions to financial crises like this very acute banking crisis is like the crises themselves. They're very hard to anticipate. So, if policymakers in this instance have believed that abrupt sales are better than a resolution to or winding down of a bank balance sheet, there's always going to be something messy to them. I mean, to come to your question in a very roundabout way, I think there's very unlikely to be any, significant issuance of these cocoa bonds anytime soon, at least from what we've, what people have been reporting this week. But I mean, I think the point I'd want to make is that it's just really one piece of the puzzle for banks right now. All deposits are costing more, and they're going to cost more after this week's, central bank interest rate hikes, no matter how they are structured. So whether it's the cost of equity or it's the cost of AT1 debt, whatever. And I suppose for UK investors, I saw one chart this week suggesting that Barclays AT1 is a bigger proportion of their risk-weighted assets than any other bank, and it's also most likely to be the most sensitive at the pre-tax profit level from every increase in the coupon price. So I think it's kind of part of a bigger picture that it's and we've written about this in the magazine this week, or James Norrington has, about the other side of the ledger that we sometimes get skipped when looking at banks, is that they have a cost of their funding and their deposit base, and that has been rising just as they're hoping to earn net interest income at a greater pace. So this is getting a tougher job for all of them to manage. Will it lead to a credit crunch or more sort of systemic events within banks? Quite possibly, but it's playing out. The AT1 drama is sort of playing out in a bigger story for this kind of risk management job that banks have to manage.
Yeah, I think that's a good point. I mean, I do think the AT1 market will come back, more quickly, if not immediately, than people think, because there's always in these cases a bit of an outcry, and then ultimately a new bond is issued a few months down the line by someone seen as more viable, and everyone gets on with it again. But you're right that the point is right now that it's not just that part of the structure that's under strain. So there's a lot of pressures there. On which note, just to wrap up, in the US, as I said at the top, we are still seeing some issues with First Republic. Julian, we are still seeing some regional bank concerns yesterday. I mean, it does seem to me like the messaging is a bit confused from the regulators on this in terms of what they want to say or how they want to respond to this crisis. We had comments from Jay Powell yesterday following the Fed hike, talking about, attempting to reassure depositors at the same time as Janet Yellen, the Treasury Secretary, was saying that a universal guarantee was not something they discussed. Now, even if you disagree with the concept of universal guarantee, it just seems the messaging is, they're not really on the same page, or they're not really organized, which might be kind of prolonging these concerns, these jitters.
Well, it probably just reflects the fact that there's no settled view, and probably in the US, no legislation either that would allow for the universal guarantee of the deposits. I mean, I think that's that would be a question for Congress to sort out. I mean, also it would be a massive taxpayer guarantee as well. I mean, we're talking the tens of trillions that would be theoretically at risk and then have to be insured. But the thing to make, the point to make on deposits, though, is interesting, is that the US deposit levels had been falling well prior to the crisis. So they'd already peaked in April last year. And it might be a sign that obviously that the cycle is a bit more advanced in the US anyway. So you could see, the idea that the Fed hiking rates at the same time as deposits are falling, it shows that they're justifiably worried about how much health there is left in the economy or how much growth there is left, and that makes that consequently then makes the outlook for legislating for kind of deposit insurance very difficult, because then how do you define what the minimum deposit base is for a bank if deposits are going out of the door structurally anyway? So yeah, it's a very complex question, and it's not really a surprise that not everyone is singing from the same hymn sheet on that.
That is fair enough. Yeah. Well, market action this week after Monday has been a bit calmer. Although that said, in banking crises, big and small, it does seem to be the weekend when the real activity happens. So, keep an eye out over Friday, Saturday, Sunday this week. The Fed yesterday as well did, I think, revise down relative to expectations its outlook for growth this year, factoring in a tightening of financial conditions already. So, just depends how that plays out now. Now I'm joined by FT consumer editor Claer Barrett, whose book, What They Don't Teach You About Money, has been published this month. Claer, welcome to the podcast. How are you?
I'm very well, thanks, Dan. An honour to be back at the IC, even if only in virtual form.
It's great to have you back as well. Thank you for joining us today. Your book is a book aimed at people in a variety of different stages of life, perhaps, whether they're just starting out or whether they simply want to learn more about money matters in general. And there's all kinds of useful info there on everything from budgeting to property and, of course, investing as well, which we'll get to in a minute. There's also lots of good information on talking about money with your partner or family or even at work. And I wanted to start on that point. I mean, is this a very British thing to be uncomfortable talking about money? Because it does feel that way sometimes, doesn't it?
Oh, absolutely. I mean, I think that British people are probably worse, certainly worse than Americans. It's very ordinary to have conversations even about investing in stocks around the dinner table in America. And it's very much something that people see that they need to do. It's a life skill, it's part of life, and it's just not embedded in British culture in the same way. Lots of us are very in the dark about things like pensions. We know what a cash ISA is, but not so much a stocks and shares ISA. And there's a feeling that investing is for people who've got a lot of money, which is one of the myths that I really wanted to bust in this book. Now, I came up with the title, What They Don't Teach You About Money, because I thought it was quite intriguing, and also because we're not really taught anything. There's very little financial education in schools, at university, or in the workplace, which is something that the FT's Flick charity, the Financial Literacy and Inclusion Campaign, is looking to change. But also, one of the problems with books about money is that the people who could perhaps really benefit from them aren't the people who are going to rush into a bookshop and buy them. So one of the titles that I had considered was a money book for people who would never, ever buy a book about money, because things like finding ways of talking, especially to your partner, about money, finding ways of breaking down the emotional barriers that might exist within your own mind to dealing with money, these are very much the first steps that we need to take before we get into the off-putting detail of products and structures and interest rates and tax relief and all of the kind of scary things that make us go, ugh. But talking about money is definitely the first step, and that includes listening to ourselves and our own fears and desires and worries about money, which in the cost of living crisis, of course, have been very amplified. So while I wouldn't say it's a silver lining to the terrible financial hardship that people have been suffering since the pandemic, it's definitely made it easier, I think, for a lot of people to lose the shame in talking about money and saying, I don't actually know very much about this and I want to educate myself and find out more. And that's squarely the type of audience that my book is aimed at.
Yeah, that's a good point, actually, about the last few years and whether that may start to change things. And leading on from that, I suppose, one other thing that's a big point in the book, understandably so, is setting goals, having goals in mind. And this is something, all investors, I think, should keep in mind, whatever their stage of life. And you talk in the book about the importance of that from a financial planning perspective and also from a mental well-being perspective, I think.
Yeah, I mean, just feeling like you're working towards something bigger is a crucial part, I think, of establishing financial independence. It's a definition that I grapple with at the end of the book, but I do think that this feeling of financial independence stems from the belief that we can do small things consistently every day over time that are going to make our overall financial picture better. And one of the things that I've picked up on is being consistent with when it comes to making a plan. You might feel that things are hopeless. If we can save £2.70 a day, we'd have £1,000 nearly within a year. And that's one of those statistics that shocks people because it doesn't sound like a lot of money, but when you scale it up, it really is. And you can apply the same in reverse to budgeting. Now, month by month, you might not think that spending £100 on Uber is all that much of a problem, but when you scale it up over a year, look at your annual total, you're spending well over £1,000 on getting taxis. I mean, even if you were to get the bus like half the time, you could reduce that bill. So I really encourage people to take a step back, look at their overall patterns when it comes to saving and spending, and think a bit more clearly about how they could generate that surplus, that all important surplus, the spare money. It's not mythical, it does exist, that we can have a goal that we're working towards, which really helps with our motivation to put that money away to a higher purpose so it can build and be invested and grow over time. And I've got lots of examples in the book about how, for young people especially, starting to put money into a pension from an early age can really snowball over time. I think that pensions have a branding problem. We think pension, we think pensioner, and that definitely puts a lot of young people off, especially at the moment when there are so many other demands on our cash. But as I say in the book, paying more into your pension could be the fastest way of getting a pay rise if your company does a matched contributions policy where the more you pay in, the more that they will pay in. But going back to the title, what they don't teach you about money, not a lot of people know that. And every talk that I have ever done, I think, about personal finance, I've said to people, make it your mission when you go back to the office afterwards to go to the HR team and find out about employee matched contributions, because that is a really, really fantastic way that you can get the biggest bang for your investing buck, much more valuable than more eye-catching things like crypto, which lots of young investors have got into, or trading meme stock shares. All of those things carry huge amounts of risk. This is a bit more boring, but I like boring and sensible, and I'm trying to do a good job of explaining the basics to people to give them the confidence to go out into the world, find out the things that they need to know, and make decisions that could really change their future financial direction.
One interesting statistic in the book that I sort of found quite remarkable as well was when you mention for a lot of people, on average, perhaps it's the age of 7 at which your money habits start to be ingrained. So that's not to say there can't be change, and obviously in a lot of cases, it's important to try and overcome perhaps some of those inbuilt habits. But that seemed really interesting, and how early we form some of our attitudes to money and saving, and ultimately investing as well.
Yeah, I mean, that's one of the reasons why on the Money Clinic podcast that I present for the FT, a question that we always ask our guests is, what's your earliest money memory? Because it gives a real insight into what was going on in that person's life when they were growing up. And we do take the biggest financial cues as children from our parents and caregivers. And depending on what kind of things really stay with you or resonated with you when you were younger, that can have all kinds of sort of unconscious influences on your behavior as adults. So lots of people, like I was born in the 1970s, similar period to now in terms of runaway inflation, high food prices, the 3-day week. I'm sure many listeners will remember this. If they don't, then let's hope that we're not going to go quite so far back to those times in the present day. But I was brought up in a family where saving money was absolutely crucial. Money was tight. There wasn't much of it around when I was growing up. And that has made me very conservative and risk averse as an adult. And in some ways, that's been to my cost, because I've always wanted to have cash in savings accounts. I've always feared investing and risking money. And it took me until my 30s, really, when I started working for the Investors Chronicle, especially, to really understand what's an appropriate level of cash to hold. How else could I put more of my money to work for the long term to avoid it being gobbled up by inflation? So that's a really important one. Lots of people who I speak to on the Money Clinic podcast have given other examples, like Sol Campbell, the footballing legend. He was the youngest of 12 siblings when he was growing up, and he told me his earliest money memory was looking at all of the property pages in the back of the Newham Gazette in East London, because he wanted to know how much would it cost to buy a bigger property where he could have the luxury of his own bedroom. Because having to share a room with 3 or 4 siblings, that's something that really preyed on his mind. Is it a coincidence that years later he's got a multi-million-pound property investment portfolio? I don't think so. So there are all kinds of ways that it can influence you, maybe with you realizing it, maybe without you realizing it. But we can also develop some of these habits or imbalances that are not helpful for our finances. So I suggest going back, having a look at these roots of our behaviors, and thinking about steps that we could take to change if they're not very helpful for our finances, and also to be really, really aware as parents what kind of examples and lessons we are providing for the next generation, which is a whole other kettle of fish.
Yeah, I was going to come on to that, actually, as you say, for listeners, with children perhaps coming up to that age, or at any age really, it's something to be conscious of as well, that financial education is important, and it isn't something they're necessarily going to learn at all in school. So that's a parental role right there.
Yeah, and one thing that has always surprised me over the years, like IC readers and FT readers who I've had the privilege of meeting, they like the fact that you get this hugely generous £9,000 a year limit on junior ISAs, but they don't like the fact that the children, the money is theirs when they turn 18, and they fear that they're just going to act like lottery winners, especially if they come into a lot of money. You do the maths. If you're saving and investing £9,000 a year for a child every year for 18 years, it's likely to be tens of thousands of pounds that could be coming their way. And I think that as well as being our responsibility to save and put money aside for children, nieces, nephews, grandchildren in our family, it's also our responsibility to teach them about what that money's for and about what investing is. And I've actually started to do that with my twin nephews, who were 7 a couple of months ago. At Christmas time, I revealed to them that Auntie Claire is saving £50 a month each into their junior ISAs, and they were intrigued. Naturally, children of any age, they're all really obsessed with money and interested in this kind of portal into the adult world. I haven't spoken to them in any great detail about what the stock market is, because it's not really a very tangible concept. But what I have been talking to them about are is what a company is, because there are lots of companies that their global tracker fund that I've chosen for them has got exposure to. That are brands they know. They've got an Amazon Alexa in their house. They know about Amazon. They know about Netflix because that's something that they use to watch their cartoons. They know about lots of other companies, car manufacturers. One of them's really into cars. Big retailers that they might go in and out of, names that they recognize on the high street. So it's just sort of planting the seed in their minds. A little bit of information over time. It's not one conversation, it's very much an ongoing conversation. And then you would hope that by the time they do reach the age at which the control of the money in the ISA is passed to them, they'll continue some of those good investing habits and be in a position where they can make a really informed choice.
Well, the book, as I say, What They Don't Teach You About Money, has been published this month. Do pick it up, listeners, if you're interested in the subject or if your loved ones are. Financial education, obviously, is crucial to the well-being of our society. Claire, I know you've returned to the IC's pages as well this month with a feature on the book, so look out for that as well. But for now, thank you very much for taking time to talk to us.
Well, it's been a pleasure, and cheeky plug, we're doing a free FT event. It's a virtual event on the 21st of April, which is a Friday lunchtime, so you can come and have lunch with the FT, and the registration link, if you want to do that, is ft.com/money event, but it's all in the IC article too.
I'm sure it'll be a great event. Thank you very much, Claire.
Thank you for having me.